Good afternoon and good morning. I'm Jeff Tucker. I'm CEO of Tucker Company Worldwide. We're America's oldest privately held freight broker, celebrating our 60th year this year. We began a series of webinars, 15 minutes long. This is our second, discussing a variety of things, but right now I'm talking about the marketplace and trucking. It'll be 15 minutes long, and I'll stick around for a few minutes, up to 15 minutes after, for any questions that we may have. So we're going to get right to it. There we go. I think most people understand that trucking is hot. It's red hot right now. And, we're going to discuss a little bit of the why and what's behind this and what we might be able to do. First of all, there's more freight moving in 2021. That's you look for the obvious sometimes. This is a graph given or provided by FreightWaves Sonar, and the blue lines and the shaded beneath the blue lines shows what the outbound tender volume is this year to date. Those previous lines are all benchmarked at a 10,000 baseline index of 10,000. So you can see that, let's see, back in September of last year, July, August, September, it was rising. That green line was rising, and we haven't looked back. So we're about 12 months into a pretty significant increase of freight and of course, a resulting capacity crisis. So this is a first chart we're going to look at, data provided by DAT Solutions and Morgan Stanley Research. Contract pricing van 53-foot van, 48-foot closed van. Contract pricing, for those of you who are not aware, contract pricing tends to be longer term contracts. Used to be two, now it's one. Sometimes it's much shorter than one in these crazy times that we're in, 1 year. But what you'll see here is the red line, the red dots, so far this year, contract pricing between shippers and carrier shippers and brokers are way higher than anything we've seen previously. Just crazy high. I should say also that please use the chat and or the Q&A button, but preferably the chat. We'll answer questions at the end. Oops. This is reefer. And for our specialized and flatbed customers and people in procurement maybe who are unfamiliar with the term, reefer is short in our industry for refrigerated. So refrigerated 48 and 53-foot trailers. Reefer, same deal. Contract pricing is way higher, significantly higher than it has been at any other point in history. This is a different source than DAT Solutions. This is Truckstop.com. And visualized by FreightWaves Sonar. Truckstop.com looks back or looks at their top 100 lanes, and their top 100 dry van lanes over the last several months. And you can look back, this gray line here, it goes all the way back to like September of last year, has been hovering at or above or slightly below that $3 a mile. And folks, this week, I think, marks my 30th year in this business, in this industry, and I dumbfounded by the fact that we are at that level. We're staying at that level. But of course, whoever could have foreseen the events of the last year? This chart is also Morgan Stanley. This, to me, is the gold standard. It's the one by which I measured the pulse that I'm feeling and seeing in the industry. This shows truckload demand, again, for van, but that red line shows this year. This year has flirted with and far exceeded the worst capacity crisis in history, and that was 2018. 2018 is that pink line that flirts with that red line. So you can see where for several of the last few weeks, months, we've been well in excess of the worst capacity crisis in history. And really for most of this past year that we've been going through, we've been spending time in that stratosphere, so to speak. And of course, high demand drives spot pricing. So spot pricing, different than contract pricing. Contract pricing, again, that 2 years, really in today's world, a year or less, an agreement to try to hold rates stable for some period of time. Spot rates is what it sounds like. The number one carrier is not available. Used to be number two or number three were available. After that, typically, if that first carrier is not available in today's market, you're going almost very often right to the spot market. And spot market is what you get. It's what you can find, a truck that you can find. A lot, typically brokers and forwarders will be very active in the spot market. But again, spot market, just like contract, way above anything we've ever seen before. And then in reefer, same thing here. Reefer, take a look at that launching direction. That's almost a 45-degree angle. And just think about this just for 1 second, right? Restaurants around the country have just opened to full capacity or are doing so now. The food supply chain was completely upended a year and a quarter ago. And it kind of got going in certain areas, and then it pulled back. And so where this is going is really anyone's guess. But the food industry is nowhere near back to where it needs to be or where it wants to be, and you know, the confusion, let's say, and the reshuffling of that deck is far from being finished. Some of the headlines and happenings also contributing to our marketplace. FedEx, just the poster child. Every LTL carrier is experiencing the same thing. FedEx announced that starting June 14th, it was going to curtail service to about 1,400 of its customers, and presumably to improve service times and that sort of thing. Well, it goes to show that no one is too big to be browbeaten, let's say, in the marketplace, and retailers went berserk when they heard that, and within a week or so, FedEx walked those comments back, right? So I would hazard a guess. I have no inside information, but I would hazard a guess that FedEx and every other LTL carrier are not sure they're going to really change their behaviors, because they have no other choice. Their systems are deluged with freight right now. They don't have enough boxes with wheels underneath them and people to drive those boxes and work in the distribution centers to be able to handle the volume. So this is a significant challenge, and something that all LTL carriers are dealing with. And look, UPS and the Postal Service, they're all slammed, instituting surcharges, and it's really everywhere you look. Defects in the chassis pool are impacting Norfolk Southern's network, and Maersk is obviously noting the obvious, and that's congestion of the East and West coasts and key Midwest markets. There's some good driver hiring information happening. It's already happened, and for the larger fleets, a sigh of relief in that driver application is positive for the first time, increasing a little bit more than 13%. I think we're all aware that Hurricane Elsa has taken lives and threatened more, and is snarling transportation, among many other things, in Florida and the Southeast, and will continue to work its way up the coast. And then, just as we are coming out of the holiday weekend, end of quarter, end of month, 1 week later, we've got a law enforcement, national law enforcement safe driver week coming next week, and that's going to target commercial vehicles and passenger cars. So mind your speed. But the takeaway here for anyone in freight is that drivers tend to often take that time off American trucking associations, I mentioned the fleets just a moment ago. American Trucking Association is the largest trade association representing trucking. They tend to represent the largest trucking companies in the country. They've talked about these driver shortages for 30 years or so, and they're saying that 60,000 drivers are needed immediately, and a deficit that's expected to grow to more than 160,000 in a few years. I'm always cautious to interpret and to understand what ATA said, because of course they're a trade association and they represent their members. If you take a look here at the data from FMCSA, you'll see that we've hired well more, the nation has hired and attracted well more than that 160,000 by 2028. In fact, we've just this year added 385,000 drivers to the national driver pool. So we've got about 3.4 million drivers in the for-hire fleet. They just happen not to want to deal with, or not to want to work with, the largest fleets. So that being the case, with these drivers going to smaller fleets for the most part, and huge churn happening at the large fleets, you'll see that the only way for these large carriers to grow is by acquisition. And we're seeing really big acquisitions happen just in the last couple of weeks. Werner bought a regional carrier, ECM. Hirschbach, a great temp control carrier, bought Lessers, another temp control carrier. And Knight-Swift entered the LTL arena with the acquisition of AAA Cooper. We introduced this sounds of the spot market in the last couple of minutes. We'll just talk about that. This is our team, our capacity team, talking with drivers and motor carriers. We as most of you know, very difficult to move freight into the Southeast. We're unable in some cases to move freight into Florida as the hurricane was approaching. The market, everyone in our team said the market felt a lot looser this week than an historic, unprecedented week last week, end of the month, end of the quarter, amidst this capacity crisis. We're seeing drivers maxing out on drive times to capitalize on the market. They don't want the 1 day. They don't want the 1 day, mid and half a day, or a quarter day next. And more on that here. Rates that look good as $1 per mile. Rate in our memory, in our memory banks, and our familiarity with what's happening in this marketplace, rates that look good on paper, if they don't give that carrier minimally $1,000 a day, there are so many opportunities for them to find that $1,000 a day. So you'll see teams not wanting to take a short haul, despite the fact there's security around certain loads. If they have to take a short haul, that is losing them money. So sometimes you're seeing an opportunity to pay the drivers for 2 full days to move an overnight shipment. That's how hot things are. Something we're not used to. We deal with mid-sized carriers, family-type companies with drivers have been there for a long time. Of course, there's churn, but around the edges. But we're starting to see drivers leave their long-term employers and pop up elsewhere. A little shocking to us. And then, of course, there has been no better example of carriers evaluating customers through the eyes of their drivers. Drivers are the tail wagging the dog today. And we've talked a lot over the years about how important it is to turn drivers quickly, treat them with respect, and maybe even have a lounge, clean restrooms, parking, those kinds of things. Never more important, because as a retention tool, carriers are saying, you know what, we can't serve that customer any longer because we're going to lose our drivers. So really epic moment. And so when's this going to end? Last minute here. Just looking back, I ask this all the time. Looking back, the first capacity crisis in my career was 2003 to 5. And that's really the first capacity crisis since deregulation in 1980. That took about 1.5 years. That was ELDs and the economy. 2014 was a shorter event, polar vortex, occurred during a growth cycle, our nation's longest economic recovery. And that took about 6 months to work itself through. But the next one that really felt, like that 2003 was 2017 and 18. So that was a little bit of stimulus. right? And ELDs. ELDs during a growth cycle toward the end of our 10-year long economic recovery. That one took about 16 months, to work itself through. This one's different. This one's really quite a bit different. I alluded to it when I talked about food earlier. All supply chains were upended 2 Marches ago, completely upended. Carriers and shippers, manufacturers, importers, exporters, everyone had to reimagine, not everyone, but just about everyone had to reimagine their supply chains. We've never seen anything like that. So new contracts, new relationships, new industries were met with contracts between suppliers. Then over the course of the next year and 3 months, the churn and the turnover and the pivoting that our economy did and the supply chain evolutions that each one of our companies have gone through are still working themselves out. We just, in the Northeast and many areas around the country, we just opened up restaurants to full capacity. We're just coming out of this thing. So, never before did we have a huge economic boom right now, and supply chains are changing. So that's unprecedented as well. So we're 1 year into this capacity crisis, and it's really anyone's guess. I don't think there's anyone anticipating it ends before this year. So folks, open for questions. Looking forward to our next market update on August 5th. I'll be introducing one of our VPs to present from a capacity standpoint, and I'm open to questions. Lee, do you want to lead us through any questions?
We do have one, which is around the number of drivers you mentioned. Is the 385,000 drivers added a net number, or does it take into account turnover or drivers leaving the industry?
That's a great question. It is a net number. We have another company called Qualified Carriers, qualifiedcarriers.com. And for a decade, we've been pulling every trucking company's data every month in 2 different imports. And we track active for-hire motor carriers. So active for hire in our vernacular means a carrier that I can go out and hire today. And that's at a point in time. So the most recent point in time is we pulled the data yesterday, and that is a net number. Now, the chart, I'll show you the chart once more. Excuse me for flipping through here. This chart shows the peak, this peak here, if you can see the peak in June, July of 2020. I think all of us recognize that around that time, things were starting to pick up, but that peak, this driver data tends to lag by 3-4 months, right? So maybe as long as 5 or 6 months. I don't have perfect insight into that. But what you'll see over time, and we've got a decade worth of this, is that the peak happens, the peaks and valleys happen about 5-6 months later after the real world event. So it very well could be that we reached 3 million drivers for the first time ever in 2021. And that might have been back, October, November of last year. We're at 3.42 million, something to that effect today. But again, this data lags. We might be higher because the market is red hot.
The next question is, what is your outlook for the 2021 peak season as it relates to rates and capacity?
Yeah, I learned long ago not to predict, so I can't predict. I did read quite a bit of perspectives from market pulse kind of data, and I read them from the carrier perspective, from broker perspective, and from a shipper perspective. And again, a lot of our source is Morgan Stanley, but Truckstop and DAT, and just being in business and knowing the market and dealing in the market. But I think most people see an increase in further increases for the balance of this year, and a further capacity crunch for the rest of this year. I think, you know, you'll see the shipper sentiment is, you know, hey, can this be over? I think I understand that. The carriers, one thing I'll share with you, we've never owned a truck in 60 years of doing business. So I hope I can speak, you know, as someone without a dog in the fight, but typically carriers are the last ones to kind of give up on a bull market, right? So, so I understand that when I hear that the carriers see this going well into next year, into the spring peak, this kind of increase on prices, increase demand. So, you know, I take that with that understanding, and then, you know, the brokers, I think, you know, are all just sort of working to figure it out too, because we're stuck in the middle of this, and it's quite painful as a broker to be stuck in the middle of uncertainty.
The last question I have in front of me is asking about what you anticipate for holiday and year-end supply of drivers, and also mentioning that new drivers may be less likely to work during holidays.
I'm sorry, could you repeat that, Lee? Sorry.
Sure. What are you anticipating for the year-end supply of drivers, especially considering holidays and new drivers who may want to may or may not want to drive on the holidays?
Well, I think the drivers right now are hustling. They're working very hard, and they're probably going to want their holiday break when they can get it. Again, if you follow any market closely, you'll see that there's an overreaction, and in every peak, in every capacity-starved environment, we've seen more drivers. By the end of that cycle, we've seen more drivers enter the marketplace than we probably need, or we needed them 6 months, 12 months before they were finally all there at the party. And that's when capacity becomes extremely abundant. So that's the wild card here. I've never seen, no one has ever seen as many drivers come into the market as there is today. We've added 1.3 million drivers over 8 years. So it's a complete wild card, but these drivers, they're earning the best money they've ever earned. There's a lot of opportunity. If you want to switch between one large carrier to another, there's tremendous opportunity for signing bonuses. So there's tremendous churn and shortage at the highest level carrier, the largest carrier. Hard to say. I think the drivers are also great at making hay while the sun shines. So they're going to, I mentioned the law enforcement action next week. I don't think that's enough to deter drivers right now. Yeah, they might go around weigh stations. They might go around, you know, and chatter a little bit about where are stops happening. But I don't think there's just too much money to be made. And these times for drivers just don't come around that frequently.
Well, that's all the questions we have. I think I speak for everyone in saying thank you, Jeff, for the presentation. I do want to point out that we will send out the recording as well as a survey for anyone who's still tuning in. Please take a minute to take that survey. And we will also have registrations open for the August 5th next webinar.
All right, Lee, thank you. Thank you for our attendees, and see you next time.